Over the past 10 years, I've had the great privilege of working with thousands of property investors all across the country. Working with them on their finances, working with the best buyers agents, some of the best property educators out there. This has informed my own property investing strategy. It is a mix of what I call alpha beta. That is investing in property that is rising in value because the market is rising in value, and investing in specific properties that are going to outperform its own market. That's the alpha component. This strategy is a mix of what buyers, agents, and all the property experts do, and my own flavor to it. What it does is it maximizes your opportunity to go and invest in property safely, as well as earn upside from potential changes to Australia and the very fact that our population is really going to be double its size in my own lifetime. That is a unique facet about Australia. It means we need to squeeze in two people where one person is everywhere. And because of that, that means there are ample opportunities for property investors to take advantage of in the long run. We're going to do a special property investor series here where we reveal all. I want education to be accessible and essentially free to those that want to learn, and that is the point of this series. We're going to cover four main topics. We're going to talk about pre-market opportunities, areas that are likely going to grow in the next few years, and tracking the macro data, largely the economic data that suggests that area is going to do better over time. We're going to track what is going to boom pretty much straight away, or what is at its early stage of its boom phase. We're going to go through the key data metrics to look at if you want short-term growth. It is all based on data and statistics and is entirely predictable, and we're going to reveal how to look for it and what our clientele and what all the buyers agents and property experts look at, and reveal that to you for free. So you don't have to pay thousands in fees if you want to simply learn how it works. I'm going to go through the third part. This is the alpha part. This is the part that buyers agents do not talk about because it is not scalable. Buyers agents and property experts want to buy the average property, and you'll hear them talk about this all the time. The average is because they can sell you lots of them. But you are an individual property investor. You are not seeking scale. You are not seeking to buy 30 or 40 properties a month. You're not seeking masses. You're seeking one or two deals at a particular point in time. So you should be very selective and chase that scarcity. I'm going to tell you exactly how I've done it, what I look for, and go through it line by line and example by example to show you how to take advantage of Australia's growing population. Lastly, we're going to talk about the art of the deal. How do you actually purchase a property? What do you go through? Let's reveal all of that bit of information to the negotiation side so you have the information you need to go and take advantage of it. That is the aim of this series, to make education as accessible as I can to you and give you the information you need to make better choices. Property markets work in cycles. If the average growth rate of property is 6%, it doesn't mean it grows 6% per year. In fact, it step changes. You will see 20, 30% price appreciations in a single year, followed by periods of stagnation time and time again for an extended period of time. Now that reveals an opportunity to you. You may want to look for areas that are about to go through its boom phase. That's what we're going to talk about in this podcast. We're going to go through the early phase of working out what areas are going to boom in the next 2, 3, 4 years so you can pre-position yourself and get some exposure in those markets before everyone is looking. This is all about macro movements and tracking what employment markets and what economic activity is going to happen to a particular location beforehand. What we are looking here for is change. If an area is going to do better versus what it usually does in the next few years, you're going to find more and more people flock to it. The housing demand goes up, and you also want to track housing supply. When you combine those two things, you start getting early indicators for markets that are going to do well in the short to medium run. So it's a great opportunity to look at. We're going to go through the 5 or 6 factors to specifically look for when trying to assess early market movers. Curtis, how are you?
Yeah, going really well. I'm pretty excited to run through this kind of like investor series because we It's probably the most enjoyable conversations in our job, more so even than the finance side of things, is like talking about investing and where people are buying, like what they're doing. It's the most interesting thing.
Yeah, you can probably tell I'm a bit G'd up about this. I'm excited because I've been asked about it. And, I follow this guy called Simon Squibb, who's a British fella who's all about making education more accessible for people. And he talks about it being a door that you want as many people to be able to walk through as possible. And the best way to do that is to make it free and digestible. And one thing that I've noticed in this sort of industry is there has been amazing content recently, amazing content from amazing educators out there, but it all comes at a bit of a cost, and that makes sense. Of course, people got to make a living. But from our perspective, as mortgage brokers, we're not property investors specifically. We are just two guys having a chat, and I want to share as much of the information that we've kind of got in our roles, talking to so many people, to the wider audience, and give them a chance to get that understanding and education of what everyone else is looking at for a much cheaper sort of free if they wanted to consume it that way. So that's the point of all of this.
I think the good part is too, a lot of the data and information that we're looking at when we're like now drilling down into these things is publicly available data as well. So exactly. It doesn't mean it takes a lot of time to go through. It does take a lot of time and research and effort to kind of wade through it and interpret it, but it's not like there's some secret data set that people are working off. A lot of the key metrics are, publicly available. So if you are prepared to kind of take the time to learn about it and go through it, like you can achieve those outcomes.
Yeah, that's true. That is a new facet as well. Like it's 2024, data is readily accessible, consumable, even digestible now from all the providers out there that make it a little bit simpler and demystify the numbers on an Excel spreadsheet, which is the raw data, and make it a little bit easier to consume for everyday Australians. So that is 2024. It's wonderful. 2-3 decades ago, be like, how am I going to find this out? You're looking at the back of a magazine, and that magazine gets published every 90 days or 12 months. And
didn't the ABS used to release like a book?
Yeah, something like that. Yeah, you'd be looking at a book, probably white pages, like newspaper, reading a small little
tables
thing with a micro glass thing to try and work out how things work. So obviously that's changed. But yeah, let's run through pre-growth factors, pre-boom markets. Let's call it pre-boom. What should someone look at? Can you name the high-level factors, and then we'll go through them in detail and explain them out so people can do their own research?
Exactly, yeah. So we've broken it down into 5 kind of key factors that you can look into. So the first one is like the state government's economic plans and population plans. Second one is supply forecasts. So looking at, approvals, starts, and where population is going to be. Third one is the interest rate environment and borrowing capacity environment. Fourth one is income levels. So this is, for the particular areas that you're researching, what are the income levels there and the expected income changes. Then affordability metrics. So what are the borrowing amounts, I guess, the prices and the borrowing amounts like compared to the income levels that are there to kind of see how affordable are these properties at the moment, because that gives a bit of an indication of what they could do. And then finally, just population growth in general, which kind of fits in a little bit with the first one, but in a bit of a broader sense.
Yep, let's basket that into the state discussion. Let's jump into the state's discussion to begin with. So when we're working out where to buy, what areas are going to do well in the long run, I'm kind of basketing this into like 8 or 9 sort of options in Sydney. You can extend it out and include some of the major regionals. So maybe you've got 15 or 20 sort of options. Let's sort of exclude the small little regional centres across Australia. That leaves you, the capitals across the country and a few of the sub-regional cities around there, Gold Coast and Canberra and the like. Well, I know that's capital, but, Ballarat, Bendigo, places that are quite large, those sort of regional areas that have diverse economies. So that's kind of the broad metrics of where most investment activity will actually occur and what we're talking about here. We talk about state performance because when a state is going to do well versus its own self relative to itself, like imagine a state that it isn't doing that well economically, then begins to do well economically, that drives housing demand. It means that they are going to get people that flock to that state. It means that people want to go buy houses. It drives activity. It means people need to buy houses. It drives jobs. So these are all precursors to additional demand. And that demand is what we want to look for. And how you look for it is by tracking what states are going to do well. So for this, I like to follow ComSec's State of State reports. So it's a quarterly report that comes out that shows how a state is performing, and the benchmark that they use and the relativity that they use to work out which state is doing best is versus itself. So how is WA tracking today versus how WA tracks on its 5-10-year averages?
Yeah.
That is what you want to look for. You don't want to compare WA to Sydney. You want to compare WA to WA itself, because you are tracking how that local economy is performing. And each local economy across Australia has its own little nuances that are too difficult to understand, but that should feed through into the data about, growth levels, employment growth, how that activity is transforming, how construction activity is going on, how retail activity is going on. How is that economy performing on the ground? That's kind of what you want to look for. And the ComSec State of State reports gives you a lot of data and just makes a really great starting point to understand that.
I think that's a key concept to unpack early is you're looking at change, not it's like, the old economic flow and stock measures, but like you're looking at change more so than stock. So like you say, you're looking not comparing like Sydney with Perth or Perth with Melbourne or whatever it may be.
Yep.
You're trying to compare them to see what is going to have the greatest rate of change from where they are now.
Yes.
That's like your indicator for growth, basically. So a state or an area that's performing really, really badly at the moment, but has really, really good prospects, like that's gold, more so than a state that's shooting the lights out at the moment and is expected to continue to shoot the lights out. Like the rate of change is a key, more crucial almost than the level that they're at.
Yeah, exactly. There's ways to explore that as well, like infrastructure investment. Where is the money flowing to? If there's large amounts of money flowing into a certain location and it's disproportionately large to the size of its own economy, let's just say the Olympic Games is a really good example. Let's just say the Olympic Games was in Darwin, right? That level of infrastructure investment relative to the size of Darwin's GDP itself, it's tangible. It moves the needle. And, you could do the same in Brisbane as well. It's just harder because that economy is much larger. But we're talking about like things that could drive economic activity in the future. So I should preface all of this is when you're looking for pre-boom markets, it is a bit more uncertain than finding markets that are about to go boom now, because the nature of the change in that economic activity is uncertain. It hasn't essentially happened yet, but you're trying to track what is going to happen in the next few years. So this early adopter sort of phase is a little bit more uncertain than finding what's going to boom right away. That becomes a bit clearer, but this uncertainty means that no one is looking there. And when no one is looking there, that's kind of when you want to be buying. There's good opportunities there. A good example could be Darwin at the moment, for example. I don't know too much about this, but like the broad sort of data sets kind of do speak a little bit there, being like, hey, look, looks like it's going to perform well relative to itself. Darwin's been in doldrums, economically for a period of time. And how's it going over the next few years? Is there potential for change there? So that one looks well. On the flip side, let's look at a different situation where we talk about Melbourne. The state budget there is concerning. It's another one where you look at being like, wow, they're in a lot of debt and they're going to have to continue to raise revenue and they have to raise revenue somehow. It's a downside factor for Melbourne being like, hey, look.
It's a bit of a break. Yeah,
exactly. Melbourne looks quite cheap right now relative to, other cities, hasn't grown very much. Rental yields are pushing up a little bit, still very weak, but pushing up a little bit because price growth hasn't been happening and rental growth has. But the problem there is the state economic activity, at least the state budget, one of the big drivers of economic activity and economic change is really a laggard and pulling the state down a little bit. So you feel a bit uncomfortable going there right now, even though on other metrics it looks pretty good. So this is a good example of like two different states and looking at how they go and working out early adopters. Tasmania is a very good example as well from a couple of years ago. Tasmania was performing really poorly and then its GDP started shooting up, people started going in, and as a result, went through a pretty massive boom. So that you could have early adopted that as well.
Yeah. I think just stepping through kind of the logic chain a little bit, you're looking for what states are going to have good economic performance relative, like you say, relative to themselves. You got a good rate of change. That's probably the biggest bit of the guessing game. Especially so early in the process. So you're looking at that. the kind of assumption is that economic growth drives population growth.
Yep.
And then you're looking at, okay, the state governments will often release, plans looking, 20, 30, 40, 50-year plans in advance to go, okay, if the population is going to double, where are they looking at making infrastructure investments? Where is the government flagging this is where these people are going to go? And that gives you a bit of a guide to go, okay, like for example, if you're like, look, I think, Darwin's going to do really well economically. Let's go find the NT government plans, their 30, 40, 50-year projections on populations and infrastructure to see, okay, if the population of Darwin's going to double, where is the government saying these people are going to go?
Yep.
So that's like the logic chain to get you from a state to now you're not looking at streets, but you might be looking at broad areas now. Yeah.
Curtis is deep diving into the alpha component here that we'll talk about in another podcast more specifically. Those are the natural series of events that you go through. I'm going to take it up a notch a little bit and give people some statistics to look at. So you want to track economic activity and employment change. You might want to look what happens before people start getting jobs. Businesses start advertising for jobs. Job vacancies start going up in the sense that more and more businesses are starting to look for people to work there. And you start seeing that, and that is reported state by state. And you could start seeing what it looks like versus what it looks like historically relative to its own averages. So these data sets are readily available. Complex data states is my starting point because it simplifies it, does it all for me. But the problem with that report is it kind of tells you where it is right now. It's a bit hard to be early adopters in that report. It's probably showing the pre-boom markets rather than the early adopter markets. But you're looking for economic activity, job market changes, and so sort of making predictions around what state is going to do well in the period ahead. There's a bit of a science to that. You can kind of foresee New South Wales not doing that well because as of right now, because interest rates are really high, we've got a financial sector economy. Meanwhile, you could see Perth doing pretty well now because for years we've had really high terms of trade, and that filters through more to the WA market than it does to the Sydney market, for example. So you can see macro factors that are driving that economic change, and there's few different data sets to look at there, and this is all crystal ball gazing a little bit. And if you got this perfect, you would be nailing each one of your property investments. But with these crystal ball gazings, the question you want to be asking yourself is what state is going to do well economically over the next few years. That's kind of the point.
And improve. I think that's the key thing. You're not looking for what state's doing the best now. You're looking for where are the improvements going to be. And you don't need to rule out states that are performing poorly or rule out states that are performing really, really well. Like you're trying to gauge the improvement. That's the key thing. So if you work out, cool, New South Wales is doing the best as of today, that's not really the key piece of information that helps. You're looking at take it forward 5 years, 10 years, like which state is going to have the biggest rate of improvement from where they are today. Like that's the key.
I might even shorten that window a little bit for property investors. You kind of want to be buying, 12, 18, 24, 36 months before this boom phase kicks in, not 5 to 10 years. 5 to 10 years is probably a little bit too long. So you kind of want to crunch. You want to be investing as close to that boom step change as possible rather than too early, because then, the opportunity cost of your money could be placed in a different location. So let's go into idea number 2. So this is supply forecast. Obviously, we've got demand, how an economy is improving. Now, we also need to be tracking how the construction industry in those areas are performing. Really high level, if there's a whole bunch of construction that's about to come online in that state, that's a little bit of a problem. Oops, I probably don't want to go there. There's going to be an oversupply. It's a mistake that I've made. I purchased in Queensland an apartment 10 years ago, and it was during the middle of an apartment boom in Queensland. I didn't really understand much about property investing. I was just like, shiny new apartment, 1-bedroom apartment, $300,000 roughly to have in Brisbane. Sounds good, tick. Okay, I'll buy that. Show me a fancy report, glossy brochure, looks good, let's invest. That's how most people get themselves into pretty poor investments. Been there, done that. That was my starting point. But you want to be looking at supply and how much supply is coming online. It is not a good thing. That's just how I want to frame it. It is not a good thing. It's marketed as a good thing, but it isn't a good thing.
Yeah, well, and the way to,
Not for
I guess,
property investors.
yeah, contextualize this is when you do your state by state research, that's looking at the demand side of things. So if you're going, okay, there's good economic performance and, I expect that's going to lead to population growth, that's the demand for property.
Yep.
But you need the context of what the supply side looks like. Like that's just as crucial. So you've gone, okay, I've found my areas where I think the demand's there. But like you say, if a whole bunch of building approvals and starts, then that's going to like level out the demand, if that makes sense. So you've got less opportunity for price growth. So your kind of Goldilocks is somewhere that you're very bullish on the demand, but they've also got very, very low levels of kind of approvals and construction. So you're looking for strong demand and basically weak supply.
Yes.
But the demand side itself, like that first set of research you did, isn't enough on its own to make it a good investment. Like you have to be looking into both sides.
Yep. So this is looking at housing construction data. So you can look at housing starts, you can look at housing approvals. So housing approvals reported by the ABS, the HIA building authorities of each state will give you the construction commencement data. So you've got approvals and commencements that showcase how many buildings are going to come online. You can forward track that over the next couple of years. Supply is very predictable, which is the upside.
It takes a while. So like, the approvals that are in the system, that is they are the potential completions in the next, 12, 24 months.
Exactly.
Yeah.
So price growth in the next few years happens in step changes because there's a temporary burst in demand that occurs that supply simply cannot respond to. That's the beauty of property. That's why it moves in step, because supply takes so long to respond. It's not like bananas, for example. I don't know if this is a good example, but bananas. If there's so many more people that want bananas, maybe the banana producers can go swap their apples to bananas and give you bananas in 2 weeks. I don't know if that's how it works, but like I'm picking a fruit, for example. Housing takes years to come online. So for a couple of years, if there's too many people wanting to buy homes and there's not enough supply and it takes a couple of years for that supply to kick on, that's where price growth happens. That's where rental growth happens. That's the demand supply imbalance that you're looking for. And it's kind of the frameworks of the data metrics that you're trying to track. Where is the demand supply imbalance going to be? And this is how. So you've got to track the supply of commencement, starts, and track that bit of information. The one thing I'll add here is this can get noisy because it's easy to look at areas where population growth is at its highest. If you look at Sydney's greatest population growth, it's always going to be out in Western Sydney, where it's just paddocks of land. Same in Melbourne. You're going to see huge population growth because nobody lives there at the moment, and there's going to be so many more people that live there. So it looks like, wow, what a demand booster. That's so good. So many people are coming in. Be a bit careful because areas with high demand in population growth also have really high supply. So this type of investing deserves its own podcast because I don't actually rule it out completely. It can work.
I've done it.
You've done it really, really well. We've met people who've done it really, really well. And I don't want to be very prescriptive and say, do this. It's more, here are the range of options. Be aware of what each of these options mean. And you can do really well in these areas where the population is going to burst if you are an early adopter in these areas and buy before the infrastructure comes in, before the change comes in, be like, hey, look, let's buy a piece of land while it's kind of a farm and then it turns into a beautiful center. You can do well that way too.
Yeah. And I think that's when you're really starting to dive down suburb by suburb. But like as a high level fundamental, if you identify that, look, I think the demand factors in Melbourne, or there's a lot of population growth in Melbourne and they have no housing approvals, then the fundamentals, if that's the example, the fundamentals are looking good. Then you have to dive down and go, okay, well, if there's a million, new people coming to this city, where are they going to go? So, and like you say, there are some areas that have the capacity to absorb those people and some areas that may not. But high level, if you've got that big demand and supply mismatch, like you're on the right track, if that makes sense.
Yep. Cool. Great summary. Let's move on to rate and borrowing power. This is one of the macro factors. We talk about it a lot. One of the key macro factors that drives demand for housing and the ability to actually buy is the financing conditions behind it. The cost of credit and how available that credit is will impact macro markets pretty much everywhere. If you're going to be buying at a time where credit is crunching, it is a tide that is swimming against you. So it's going to be harder pretty much all across the board. Lower interest rates, more credit will pretty much positively impact all asset classes and in particular property because people need credit to buy property in Australia. Less so in the last 12, 24 months, but definitely en masse, people need credit. So interest rates and borrowing capacity changes help drive a bigger macro change. So this isn't location specific, but just a bigger macro change being like, hey, look, you probably want to be buying when interest rates are going to fall and when they're going to give you more money. We've seen this time and time again. We've done a number of podcasts on this. You can go back on previous podcasts and get a real sense of the history of Australia's property market and how it's responded very closely to net borrowing power changes and interest rates.
Yeah.
Want to add anything to that before we move on to the next one?
Yeah, I just think it's a kind of a bit of a forecast, maybe over 2-3 years. It's not location specific, but are you going to be swimming like with the tide or against the tide, basically? And if you think you're going to be swimming against the tide, doesn't necessarily mean you don't do anything, but like just keep it in mind. If you think you're going to be swimming with the tide, then like it's another big tick.
For sure. For our audience listening here, go back a few episodes. You'll see us talking about a potential 35% increase in borrowing power. Now, the point of this isn't to tell you that there's 35% coming, but it gives you the mechanics of how. We have 5% kicking in on 1 July, pretty much next month when the tax cuts kick in. We have a potential 10% increase when APRA decides to normalize the assessment rate. They've done it for refinances, but when they do it for purchases, there's another 10% coming. There's potentially another 10, 15% coming when interest rates begin to normalize. Again, all of this means there's going to be more credit flowing through the system. It's going to be cheaper. More people will want credit. And when more people want credit, that drives up housing demand all across the country. Sydney and Melbourne usually benefit more, in Brisbane, but broadly across the country, that benefit is kicking in. So that's a really quick summary of it.
Yeah, and I think I'm going to say it again, repeat this point because I think it's worth repeating. Like you're looking at change again as well. So it's not like our rate's high now. You're doing like your next 2-3 years, our rate's going to get more restrictive or less restrictive. Yep. Like it's not a what's happening now, it's your forecast over the next couple of years. It's that change that counts.
Yep. We're a Sydney-based podcast. Everyone largely knows that. Sydney property markets are driven by this in particular a lot more than other property markets. More expensive markets will be, while cheaper, more affordable markets where people are not borrowing to their maximums, where incomes are quite high versus debt-to-income ratio is a bit lower. Less sensitivity there. But still sensitive enough. It's a positive momentum regardless because it changes asset valuations and the hurdle rates that asset valuations are driven by too. So let's run on to the last one. We've got, the second last one. Let's call it the last one. Affordability metrics. So this is another one to look for early adopter markets. Do you want to explain this one out? And I can add to it.
Yeah, I think so. The concept we're trying to get to here is basically looking at what are house prices and by extension loan amounts going to look like in the areas that you are relative to incomes. So the idea being if housing affordability in a particular area is really, really stretched, people are having to put a really, really significant percentage of their monthly pay into a mortgage or into rent, that provides a little bit less opportunity for prices to push up further because the local population isn't able to basically support that increase in prices with, their incomes. So having a bit of an idea for how affordable it is just gives you a bit of a sense as to whether there is a little bit of capacity for price growth in the area, or whether it's people are already stretched to the absolute limit. And, if you're getting another 5, 10, 15% rise in house prices, that people aren't able to sustain it. Because if they're not able to sustain it, that's going to drag a little bit on your upside.
Yep. I call affordability metrics, it kind of sets the cap end as to how far something can grow. So when affordability is so stretched relative to its previous levels, it probably suggests that, hey, look, price growth is limited a little bit. At least it can't go up another 30, 40, 50, 60%. That step change is harder to achieve when affordability is so stretched. One other metric that I would like to see and run, and it's my soft little smell test for Sydney in particular, is the rent or buy equation in that state. In that market, does it make sense for someone to go and rent or buy? This is particularly the case in Sydney. You allow a slight negative spread, a premium for buying versus renting. 1% premium for a house, that's kind of a really, really soft test, being like, cool, if your house is yielding 4%, but the interest rate is 6.5%, being like, well, that's a big spread, like in terms of the difference between renting and buying. So renting is much cheaper. That means affordability is stretched pretty tight as well. Meanwhile, in a different market where rental yields are 6% and the interest rate's 6%, affordability is very strong there. But you want to kind of get a little bit of gauge of how it works in that market in particular. So it's a soft little smell test that I use. Is affordability a restraint in that area? The buy to rent spread is something that you factor into that sort of location to work that out. That's how affordability looks. There's one more that we missed out on by the looks of it, net income changes. Gross wage rises basically, and tax cuts that feed into net incomes. Do you want to unpack this one out for the audience?
Yeah, I think this one's relatively self-explanatory, and it flows out of the state kind of economic performance a little bit.
Yep.
So ideally, stronger state economic performance is resulting in rising incomes in that area. And it flows into affordability a little bit in the sense that if you're bullish on income rises occurring, that helps affordability. But basically, you're looking for areas where you're expecting rising incomes over time. That's going to essentially support higher house prices in that area.
The hills.
Yeah.
For those that listen, the hills of Sydney. I am pretty sure, I don't know the past 20 or 30 years that much, but I didn't know too much about the hills. While I know that a lot of high income Australians live in the hills at the moment, and they have the highest incomes in Sydney or just about there. And that statistic is probably a new statistic. So it suggests that, aspirational people are moving into those areas. That's owner occupied demand driving into that. So that net income change helps drive that demand. So here's a whole gamut of things to look for when trying to work out what market's going to do well. We're providing a little bit of a framework, a bit of a scattered framework, but a framework nonetheless to look for and some of the data pieces to unpack. What you're trying to do is unpack which state is going to do well relative to itself. You want to be looking at state economic data. You want to read the CommSec state of state reports. You want to see job vacancies in that area. You want to track population growth of that location versus the demand that is coming in and the supply that is going to be brought into the market via commencements and approvals. You want to be tracking all of that building data as well and tracking how demand and supply is working against each other and how that could change in the years ahead. You want to ideally be buying in macro conditions where net incomes are rising and borrowing power and credit conditions are working in your favor. That will make it a little bit easier. It means more options will be on the table. Last few years, we've been talking about Perth, but there's been some softer growth across other markets because of borrowing power conditions. But when borrowing power is improving, you find that there's a rising tide everywhere. And you want affordability to be there to, one, make it easier to hold, but also provide you sort of uncapped potential in terms of the amount of growth that is possible in that location. And it's all about change. You want to look at how an area is changing. So that's the summary piece for finding early adopter markets. I hope you found this one particularly valuable. We're about to go through what areas are about to go boom.